Hello everyone. So now we are going to discuss about how to do the recording of business transaction. Sale of goods, purchase of goods, shop rent paid, electric charges paid. All these are business transactions. So we need to record it in the books of accounts. So books of account means a set of books which are being maintained to record the business transaction. In that set of books, one of the book is going to be called as journal. So every business transaction for the first time, every business transaction is to be recorded in a book that is called as journal. So in journal, whatever the transaction we are going to record it, that is going to be called as journal entry. So every business transaction for the first time, it will be recorded in a book that is going to be called as journal. And what are the transaction we have recorded, whatever the entry we have recorded in that book, that is going to be called as journal entry. Sir, what do you mean journal entry? A systematic way of recording the transaction. A proper way, a systematic way of recording the business transaction is called as journal entry. See, you might have observed in case of some petty shops and all, small shopkeepers. Even those people also record. Even those people will record the transaction in a book, in small diary or in some notebook or something. They record the transaction. But the way what they record the transaction, that is unsystematic way. Everybody cannot understand what exactly they are trying to tell by seeing those transactions what they've recorded, because they have recorded in an unsystematic way, which is not universal, which is not being followed by everyone. Systematic means which is followed by everyone, universal. Everyone can understand that what exactly they are trying to tell by recording those transactions. So every business transaction for the first time, it will be recorded in a book called as which one? Journal. By passing an entry called as which entry? Journal entry. Journal entry is what? A systematic way, a proper way of recording a business transaction. Now listen. For example, let us say electricity charges paid 2000 rupees. I want to record it for the first time in a book called as what? Journal. So when you record the transaction in journal, every transaction should be recorded only based on supporting documents. By seeing that electricity bill, water bill, invoices, sales bill, purchase bill, we record the transaction. So if you want to record the transaction in the book called as journal, it should be based on supporting document. Supporting document means evidence of the business transaction. Purchase bill, sales bill, electricity bill, etc. Without a supporting document, without an evidence of a business transaction, a transaction cannot be recorded in the journal. So there is a rule which says that every transaction recorded in the books should be based on some evidence of business transaction. That particular rule is called as objectivity concept, or we can say verifiable objective concept. Objectivity concept or verifiable objective concept. See, there are two terminologies are there, two terms are there: subjective and objective. Subjective means based on opinion. Suppose if I ask you what is the price of this marker, different people will give different answer, because these are based on your opinions. This is called as subjective. But we don't record transaction in the books based on opinion. We record based on evidence. Suppose if I give the purchase bill, I purchase this marker from Apple store. What are the bill I received from them? If that bill, I will give it to you people. And by seeing that bill, if you tell what is the price of this Apple pencil, then everybody will give same answer. because you are giving the answer based on evidence, based on bill. That is called as objective. Objective means based on evidence. Subjective means based on opinion. So they say that if you want to record the transaction in the books, based on evidence you record it. It is called as objectivity concept or verifiable objective concept. Yes. So we understood that every transaction for the first time it will be recorded in book called as journal. And what are the entry we record, that is called as journal entry. Now we need to understand what are the rules for passing the journal entry. If you want to pass the journal entry, if you want to record the entry in the book called as journal, how do you record it? How you are going to pass a journal entry? Now listen. As we discussed earlier, every business transaction, for example, sale of goods for cash, you're selling the goods for cash. Then what will happen? Goods will go out of the business and cash will come into the business. So here two things are changing in the business. One is goods and the other one is cash. Whenever you pass a journal entry, first you find what two things are changing in the business because of that particular business transaction. Sir, what do you mean by two things are changing? Something will increase or decrease in the business because of the transaction. You sold the goods, so goods will decrease. You received the cash, so cash will increase. These are the two changes. Goods are decreasing and cash is increasing. So the two changes first you find out. Once you find out the two changes are goods and cash, then you find that which one is increasing and which one is decreasing. Which one is increasing and which one is decreasing. For example, here cash is increasing and goods are decreasing. Now to record how much cash has increased or how much goods has decreased, to record this increase or decrease, you use the word called as debit and credit. Debit credit is the alternative name for increase decrease. Instead of using the name called as cash has increased by this much or goods has decreased by this much, instead of that we use the terminology called as debit and credit. Name called as debit and credit. But don't think that debit means always increase. Debit is increase as well as decrease also. Credit means increase as well as decrease also. So when we should understand increase means debit or increase means credit, for that we have the rules for debit and credit. Now what that rules for debit and credit says, whenever asset or expenses increases, whenever asset or expenses increases, they say that we have to do debit. Asset expense increases, we should do debit. But whenever income liability capital, because of a business transaction, if you find that your income liability or capital is increasing, then you should do credit. But because of your business transaction, if asset or expense is increasing, then you should do debit. So rule is that asset expenses increases or created, whenever your asset or expense are increasing or it is created, then you should do debit. But for income liability capital, whenever the increases or created, we should do credit. Sir, what if it is decreased, then you should do reverse, ulta. Increase debit, then decrease will be credit. Increase credit, then decrease will be debit. So what is the rule is asset expense increases debit, decreases credit. Income liability capital increases credit, decreases debit. Now one doubt will arise, sir, what exactly this debit and credit is? Why they are using the two names? One debit name, one credit name and all. Now see listen. Just one example I'll give you. Let us say in your business multiple times inflow of cash will happen and multiple times let's say outflow of cash will happen. So money will become inflow multiple times and outflow multiple times in a day. Now to record how much money came in and went out, you have two approach. One, what you do, you take one sheet of paper and just in one column you record inflow also, you record outflow also. Let's say inflow 1000, outflow 800, so net 200 cash is left out. This is one approach. Or else what you can do, you take one sheet of paper, there we write as cash. This is also cash only, here also I'm recording cash transactions only. Inflow and all you write on the one side and outflow you record on the other side. So you make two sides, one is right hand side and one is left hand side. If anything increases you write it on one side, if anything decreases you write on the other side. Let's say cash came 1000 rupees, cash went out 800, so came 1000, went out 800, so left out is 200. This is second approach. So if you observe these two approach, more comfortable, better way of understanding is second approach. Increase all on one side, decrease all on the other side. So these two sides are called as debit and credit. These two sides itself is called as debit and credit. This left hand side is called as debit side and this right hand side is going to be called as credit side. So debit and credit is two sides of a single page. One is debit and the other one is which one, credit. So what is the rule is for asset expenses. For asset expenses, for example, let us say cash. We know cash is an asset. So debit and credit. For asset expense, what is the rule is if it increases, you do debit. If it decreases, you do credit. This is the rule for asset expense. But whenever you are talking about income, liability or capital, for example, bank loan is a liability. We taken loan from the bank, it's a liability. So when liability increases, you write on the credit side. But when it decreases, you write on the debit side. And if you remember, in earlier class we discussed that asset expense comes under the same category because there is an outflow of money. Income, liability, capital comes in the same category because there is an inflow of money. That is the result. That is the reason there is same rule for asset expense and same rule for which one? Income, liability, capital. Income, liability, capital one rule, asset expense one rule. So I hope you have understood this rules for passing the journal entry.